All right, so welcome to 443 Applied Equity Analysis. My name is Joe Perfetti. I'll be the instructor for the semester. I think this is the 6th year I've been teaching this class. And basically what I want to do is talk a little bit about the syllabus and expectations for this semester, and then also start getting into lecture note 1. So just as a quick introduction, in addition to teaching this class, I'm actually teaching 5 classes this semester. I teach an MS version of this class this morning at 8:30, and then I teach this class for the undergrads 4 consecutive sections starting at 11 a.m. I don't know why. I keep saying no, and they keep adding more classes. So one year I'm going to stop. But in addition, this is my kind of part-time job. My full-time job is I'm a practitioner. So I actually do this stuff for a living for a lot of companies. So the rest of the week, outside of Monday and Wednesday, I am not on campus. So really the only time I'm on campus are Mondays and Wednesdays while we have this class. The good news, bad news for you is that because I do work with a lot of real world companies, I'll be bringing in a lot of real world publicly available data to talk through a lot of issues. The key word to this class is applied. That unlike probably any other class you've taken so far at Smith, this class is really going to try and bridge academia with the real world. So you spent 3 years or 4 years, some of you seniors, basically learning a lot of academic principles. This is all about how do we try and take this out into the real world and put it into practice. So that's really what we're going to focus on this semester. So this is my email address. This is my phone number. I have an office on the 4th floor in the finance department, 4468, which is primarily going to be used by my TAs. You can see that I teach the MS class from 8:30 until 10:20. So my office hours are between 10:25 and 10:55, basically the start of this class on Monday and Wednesday. Don't have a lot of free time. So I'm available via phone, but the teaching assistants, I have 2 of them, which both of these students took the class last semester and did very well. So they are my TAs, and they both have access to my office in 4468. Mandy, her office hours are going to be Wednesday from 1 to 3, and Mike's office hours are Thursday from 5 to 7. Okay, and that's their email addresses. So basically, the TAs are going to be doing all of the grading. So they're also good people to know if you have any grading questions, because they're going to be grading all of your assignments. Right? So again, the key to the course objective is how do we take the core academic principles and apply them to real-world valuation content. So this semester, I'm really going to teach you 4 major themes. How do companies, analysts at the banks, how do they value companies? And when they write their sell-side research recommendations, the buy-sell holds, how do they create those, and what are some of the types of analysis that they do? This, more than anything else, is also going to be a process-driven class. So I'm going to also teach you the process, and you're going to apply the process a lot in how we go through these things. So 4 major themes that we're going to be talking through. One is we're going to introduce a framework starting next week called EIC, which stands for Economy, Industry, Company. About half the performance of a company is based on the external industry conditions. So how do we understand what's happening at the industry, how it's going to change over time, and what the impact on a company will be? Second, we're going to look at historical analysis. And I'm going to teach you how to take accounting statements, GAAP accounting statements, turn them into economic statements and cash flow-based statements so that we can do more straightforward analysis of companies. And then 3, how do we then take those statements and forecast them so we can forecast cash flows to create a forecasted valuation of a company. And if you don't know Excel by the end of the semester, Excel will be your friend, because you're going to be doing a lot of work in Excel this semester individually. You'll actually be creating your evaluation model, a full-fledged valuation model, and you'll be valuing real-world companies as we go through the semester. And then finally, we'll talk about multiples as an alternative form of valuation, price to earnings ratios, enterprise value ratios, what they mean, how they're created, and how they're applied. Okay, so those are kind of the 4 major points of the class. As part of Maryland's blended learning initiative, this class is going to heavily rely on that. So that means that just about every class is going to be recorded and put on YouTube. There will also be some classes where you'll just watch the class on YouTube. You won't come here physically, and then you'll do work in the lab. And then we'll also have some webinars. So instead of having a physical class, there'll be a virtual classroom. So there'll be a combination thereof. Probably 70% physical class, but 30% will be non-physical class. I just wanted to give everybody that warning in advance. When I started this 2 semesters ago, I was only videotaping the virtual classes, but the students actually said they wanted every class taped. So that's one thing I'm doing. You're seeing right now I'm recording this to post on YouTube so that we have a reference of every class this semester, which is good referenceable material as you go through. So this is the link on YouTube to get to all the videos that we're going to post. And again, you can also search for my YouTube channel, Joe Perfetti, and you can see last semester's videos as well. There is one textbook you will need for this class. It's called Valuation. It's the 5th edition. The bookstore carries the university edition, but you don't need the university edition. Any 5th edition will do. I use the Kindle edition. You can also get it from Amazon, the 5th edition, so any source of the 5th edition, but you will need a 5th edition of the textbook. It's called Valuation, probably by next week. The only other thing besides the textbook that you'll have to pay for this semester is the stock track simulation. So there is a group project that you're going to be doing this semester called Stock Track. You'll divide into teams of 5 to 7 people by next Wednesday. And so if you're not in a team, I will assign you to a team, because 30% of your semester grade will be 2 group projects where the entire team gets the same grade. And one of the team projects is a simulation called Stock Track. So, because this class is real world, we have to pay attention to current events. The only way I'm going to get you to pay attention to current events is to do the Stock Track simulation. The idea is you'll start out on February 5th with $1 million portfolio, fake dollars, but you can do any sort of trading in stocks, everything else is restricted, buy, sell, short, and you basically can manage that portfolio until May 7th. So on May 7th, you will be scored. The company with the best the team with the best performing portfolio gets the best grade. The team with the worst performing portfolio gets the worst grade. It's actually the exact way you'd be doing the real world. The difference is they would fire you. But other than that, it's very competitive. And so basically, Stock Track is 10% of your semester grade. The best performing team gets 10 points. The worst performing team gets 6 points. And everybody else somewhere in the middle. Okay, so that'll be one of the group projects. Stock Track costs $26. One team member will need to pay for it using a credit or debit card. The other team members will need to reimburse that person for their share of the $26. So again, approximately $5 each that you'll have to pay for Stock Track. So again, you need to form groups of 5 to 7 people. And again, if you're not in a group next week, I will put you into a group, but everyone in this class needs to be part of a group. So again, you need to pay attention to current events, because a lot of what we do in this class is going to be based on the real world. So, what happened to the stock market last week? Speaking of current events. Yep.
There's a lot of fear in the markets.
So what was the result of the fear?
Severe drop.
Yeah, it was a big sell-off, and the market was pretty much down pretty substantially last week. Biggest loss since 2011 in 1 week. So, why? What were some of the catalysts that led to a drop in the value of the market last week? Yep.
Bad earnings reports.
All right, one was bad earnings reports. What earnings report kicked it off that really scared the market? Anybody know? It was actually Best Buy. Best Buy said they had a horrible holiday quarter. Revenue was a lot worse than they thought it was going to be, and earnings were miserable. And then right after that, a bunch of companies saw their earnings not meet expectations. All right? So if you think about it, a company's worth the sum of its future cash flows. Earnings are hopefully a predictor of cash flows, or so the market thinks. So the idea is, if we don't get the earnings, we don't get the cash flows that we thought, stocks aren't worth as much as we originally thought. So as much as that logic plays out, that was playing out in the market last week. What else? What else hurt the market last week? I'll give you a hint. It involves the word taper. Why is taper an important word? You said the Fed. What's happening with the Fed?
I don't know, just know that they can either taper or not taper.
Yeah, they're saying taper, not taper. What is taper? It's not a worm. What is it? What's the taper?
They're just scaling back their bond purchasing
And why is that so important?
because it'll affect interest rates.
Yeah, so high level, since 2008 financial crisis, when the U.S. government runs a deficit, who sells the debt? What government agency actually sells the debt when we actually sell bonds to fund our deficit? Does anybody know? It's actually the U.S. Treasury. As a matter of fact, on a side note, you're going to see a lot of horrible headlines over the next few weeks because the Democrats and Republicans are going to play Russian roulette with each other over raising the debt ceiling. And you're going to see me get angrier and angrier because there's no reason to have this debate. All right? Because basically what happens is, and this is just a side note, that we already spent the money that Congress allocated and said it was okay to spend, and now we're saying that we're not going to pay the bills that we said we were going to spend the money on. Unless we raise the debt ceiling, we can't pay the bills because the Treasury is restricted on how much debt it can issue. We're going to hit the limit, and they can't issue new debt to pay bills that Congress already spent. And we're going to have this crazy fight over the debt ceiling when the money was already spent. That's what I said. That what will get me enraged beyond belief is that why couldn't they have not spent the money? Like, make the argument over not spending the money. Don't spend the money and then tell the rest of the world we're not going to pay our bills. That's like the worst form of negotiation that we could do, because that's what's causing all this uncertainty in the world. Anyways, back to this. So the U.S. government right now has a giant deficit, and the U.S. government has been printing money by basically doing what? I think last year's deficit, somebody correct me if I'm wrong, but I think it was like $1.4 trillion. Does that number sound about right? It's 1.2 or 1.4 trillion, right? But here's the point. Who is the biggest buyer when we sell our debt to fund that big deficit? Because we spent $1.4 trillion more than we took in. Who's buying the debt? Yeah. China is not the biggest buyer of the debt. The Federal Reserve is the biggest buyer of the debt. So basically, the U.S. Treasury sells it, the Federal Reserve buys it. It's called printing money, 21st century style. So that's actually what's happening. The Federal Reserve last year bought $80 billion a month of our debt. Times 12 months equals $960 billion. So of the $1.4 trillion of new deficit, $1 trillion was purchased by the Federal Reserve. We are the biggest buyer of our debt at auction. Now, one of the advantages of buying our own debt is it keeps interest rates low. Because if we didn't buy our own debt and the rest of the world had to buy our debt, we'd have to pay higher interest rates. So it actually keeps interest rates low. So here's what's happening. At some point, the Fed can't keep buying all of the debt at auction. It will start to have negative consequences in the real world. So that's where the Fed is saying we're now going to taper or slow down our buying. So that last month, instead of buying $80 billion at auction, they bought $70 billion at auction. And as they said that they were going to start tapering, long-term interest rates went from 1.7% to 2.7%. And that kind of freaked everybody out because a little bit of tapering led to a big jump in interest rates. And here's what I know about present value. What is the formula for present value? Just straight financial formula. Present value equals what? Yeah.
Future cash flows discounted to the present.
So cash flow divided by 1 plus R to the T or the N. Okay? So here's what's happening. What happens in the present value equation if the R goes up? Then the present value goes down. Well, that's the other pressure that's now happening in the market. As the Fed is actually starting the taper, interest rates are starting to spike. As interest rates started to spike, those cash flows, the equity values are being discounted at higher rates. Higher discount rates equals lower value. Now, the argument was we have a strong economy, so if we use a higher discount rate, how would we have a higher present value? What would have to happen? We need higher cash flows. So that's the point about earnings. We thought that the earnings were going to be strong, so that's why the Fed was able to allow interest rates to rise, because they were going to discount higher cash flows and the stock market would still go up. But here's what's happening in this earnings seasons. Earnings are not going up. Cash flows are not going up in general. People are worried about the earnings, and the higher discount rates caused the 4% plunge in the market. Then, and this is how I don't read the signs. So I was watching Silver Linings Playbook, and Jennifer Lawrence has a great quote where she talks about reading the signs. And I'm just telling you, I was reading the signs last week. I was in my Fidelity account online with my portfolio, with my finger on the sell button, and I couldn't pull the trigger. I feel like an idiot because it just cost me 4%. Because I know you should never time the market, but all the signs were pointing to timing the market down, and I couldn't pull the trigger because I justified it with, oh, I'm going to take a long-term approach. But I'm taking a long-term approach with 96% of my portfolio value of 2 weeks ago that I could have gotten out of. Anyways, that's an aside. Here's why. I was reading an article, and this is why you got to pay attention to current events. It's the Wall Street Journal, and it talked about how Goldman Sachs said that they're worried about the stock market values of the U.S. stock market. And I just clipped it into Evernote. But here's the important point. Buried in the middle of the article, where they were interviewing Goldman Sachs, is this guy who's their chief investment strategist said that Goldman Sachs notices that the S&P 500, 500 largest companies in the U.S., generally trades at 13 times forward earnings since 1970. And right now the market was at 16 times forward earnings. And every time the market hit 17 times forward earnings, there's been a correction. And markets tend to regress to the mean over the long run. So basically Goldman Sachs was telling them publicly, and they've been telling their clients, that the market is at the peak of its valuation. That it's going to be hard to see the market go up further without more earnings growth. And if discount rates go up, it's going to hard to have a market with a PE of 16, and we're going to start heading back towards a 13, which is exactly what's happening in the market last week. So I'm saying we're going back to a natural rate of valuation, closer to the 13 times earnings, and this was the quote-unquote correction that we're in. So I'm just telling you, this is what you need to start to understand about the market. How some of the events that are playing out in the real world correlate to changes in the stock markets or changes in company values, which means you got to start paying attention to the market. You got to start paying attention to the news. Okay, so anyways, at the beginning of many classes, we'll be talking about the news and these current events. And the nice thing is you can actually try these theories at work in the comforts of your own portfolio of non-real money. Right? So you can actually try it out, see how it happens. And the worst that you can do is lose half a letter grade. All right, so back to grading. 100 points this semester available towards grading. To pass this class, you need 70 to get a C minus. Right? So 70 points is a C minus, 73 is a C, 77 is a C plus. What you care about, 90 is an A minus, 93 is an A, 97 is an A plus. Okay, standard grading for the university. So 5 of the 100 points are attendance. This is a process class. Here's why that matters. I'm going to be teaching you a process that kind of builds on each other week by week by week. If your goal, second semester senior, is you want the gut class where you show up in the first day, show up in the last day, and just take the exams and never show up in between, this is not the class for you. You should really drop it. Right? Because this class involves kind of building on things that we talk about each and every week. And if you miss like a month of class, you're going to be completely lost, and there will be no helping you to pass the class at that point in time. So that's why there's an attendance component to the grade. So I'm not saying you can't miss a class here and there, and we're going to be videoing classes so that we'll keep you in check. But I'm just telling you, if it's first class, last class, and nothing in between, find a different class. All right? This is not the class for you. All right? So 20% of your grade will be 10 homework assignments, 1 a week for 10 weeks. So that's the other thing, is we have to continue to apply what we're learning to make sure we understand it. So there's pretty much going to be a weekly homework assignment in this class. In addition, 20% of your grade will be the midterm exam. It's actually a 2-part midterm. And 10% of your grade is the stock track simulation. 20% of your grade is going to be a second group project. So about halfway through the semester, we'll pick an industry. One of the industries we picked last semester was airlines. You'll then pick a real airline. So Southwest, JetBlue, US Air, whoever. And then you'll value that company and you'll do an analysis based on the real world data that they have and the principles we talk about in this class. And that you'll turn in a 12-page or so written analysis plus another 20 pages of exhibits on that company. Final day of class. You'll also do a 20-minute PowerPoint presentation as a team on that company the last week of class. Okay? You'll start that project about halfway through the semester. And then the last day of class is the final exam. That's about 1/4 of your exam. It's a take-home exam. It'll be handed out the last week of class. You'll have a week to take it. All the exams and all the assignments this semester, open book, open notes, open computer. Right? In the real world, nobody makes you memorize anything. So this is a real world class. You don't have to memorize anything. The only limitation is on the assignments that are individual, you can't collaborate. Right? But on the group assignments, you can. But like exams, you can't collaborate, but they are going to be open notes, open computer. And you will be using a lot of Excel. Okay? So for the attendance part of your grade, you don't lose attendance until you have your second unexcused absence. To get an excused absence generally requires one of 4 things. If you're sick and can prove it, excused absence. If you're doing any university documented activity, that would be considered an excused absence. If you're doing an interview, that would be considered an excused absence. And if it's, religious holiday, something like that, other excused absence, or death in the family, emergency, something like that. Here's the key. To get an excused absence, generally, unless it's an emergency, you have to send an email to myself or the TAs before the class. So, I have an interview with Goldman Sachs next Wednesday, can't make the class. So send us an email before next Wednesday's class, that will be considered excused. If you have an interview with Goldman Sachs next Wednesday, you go to the interview and you come back the following Monday and say, I missed the class, can I make up the assignment and have an excused absence? Then you'll get a double hit because I won't let you make up the assignment and I will consider it an unexcused absence. So again, what you'll find, and this relates to the late assignment policy, is in the late assignment policy, generally, if it's late, I don't grade it, you get a 0. And the TAs, which went through that last semester, are now battle hardened, and they apply the same principles to all grading. So if you have a issue or challenge, talk to us before deadlines. Before deadlines, we're flexible. After deadlines, we're far less flexible, right? And I tend to hold the line on missed assignments. So if you missed the assignment, you don't have a good excuse, I will not change the grade, to the frustration of a lot of students. As a matter of fact, last semester in the team assignments, there were 10 really pissed off students. And the reason why is because 2 teams failed to turn in their final group project on time. Now, it was one of the group members in each of the groups, his responsibility to do it, didn't do it, and the whole team got a 5-point penalty. So the entire team lost a half a letter grade on their entire semester's grade because one of their team members didn't turn the project in on time. And I wouldn't change their grade. So I'm just letting you know, I'm unfair, I'm mean, but I'm going to be fair to everybody else that followed the rules. So back to the grading, I'm kind of a stickler to, I'm flexible before deadlines. The TAs will be flexible for deadlines. After the deadlines, not so much. So again, if you're the person that can't meet deadlines, doesn't want to do homework, and never wants to come to class, like I said, we're still in the drop ad period. It's a good time to leave. All right, so if you have any special needs, please let me know. Please follow the honor code. At the end of the semester, we'll do a course evaluation. And finally, there's what I'll call the Bloomberg account creation. So you'll notice that you are in a Bloomberg lab. This is unique. There is no other university in the world that has a real-time teaching Bloomberg lab in an academic setting with this many terminals. The Smith School has 48 Bloomberg terminals in the school, and no other school in the world has nearly this many terminals. Matter of fact, Bloomberg wants to write case studies about us because they're trying to figure out why we're using Bloomberg so much. And the reason we're using Bloomberg so much is I have 200 students a semester, and I make it mandatory that every one of them sign up for an account. And so the more we're using it, the more they gave us all the hardware in this room for free. So software is a different story. Software costs $20,000 per person per year. So it's ridiculously expensive software. Now, the cost to you as a student is free. Okay, so basically you get to use some very expensive professional software. So if I do work at Goldman Sachs and I'm on the bond trading desk, this is the software that I will be using to trade bonds. This is fixed income, this is equity, this is the analysts are using this to do their research. So again, you're using what the pros use. That's one of the advantages of this class. Right. So as part of this, you're going to be using Bloomberg pretty heavily. So one of your first assignments is to get a Bloomberg account. Right? So how do you do that? There are two Bloomberg labs on campus. One is in this room. The other is in 1517 on the first floor in the finance lab. On the computer, you'll see the software. It says Bloomberg on it. You just double click on the software. It will load the software. Now here's the thing. You can actually go to Bloomberg.com and download this exact same software onto your own computer. However, Bloomberg, and this is Michael Bloomberg, by the way, the reason Mayor of New York is a billionaire, is very protective of his software. So every piece of software has a unique serial number and a unique hardware ID that ties the serial number to the hardware that it's installed. So my laptop is a Bloomberg registered terminal. Every computer in this room is a Bloomberg registered terminal. Every time you open the software, as a security check, the software communicates with the Bloomberg database and validates that it has an active license on the computer that it's supposed to be installed upon. So if I try and install this on another computer, even if I have the serial number, because I won't have the same hardware ID, it will say, don't load the software, give you the number of account services. You'll call account services, they'll ask you for $20,000. And they don't accept credit cards. So you cannot use this software unless you're ridiculously wealthy and got $20,000 to burn on your personal computers. You will have to use it in this lab or the lab downstairs. So just letting you know in advance. But the nice thing is, because Bloomberg knows every computer that Maryland has by unique ID, we have it what's called an open license. So for students, any Bloomberg terminal at the campus, you load the software, choose your language. I'm going to choose English. And there is a create a new login option. You click on create a new login. Because it knows that you're at a terminal, it will allow you to create a free login account. Right? So what you'll have to do is, again, choose your preferred language again. Are you creating a login for yourself? Say yes. Because if you create it for somebody else, it's like a bear trap. They're going to be like, why are you doing this? Right? So you are creating it for yourself. Have you ever used Bloomberg before? Most likely no. Hit continue. It's going to ask you to type in your name, choose a password, put in a phone number, and an email address. Now, where it says corporate email address, it can be any email address. It doesn't have to be a umd.edu address. It could be a yahoo.com address. They don't care. Right? Because they know it's created on this terminal. And then once you do that and hit continue, they're going to send you a verification code. You'll type in the verification code, and then they'll give you your account username and then the password that you selected. You then have an active account. Entire process should take 3 minutes. Right? So between now and next week, you need to do that. And again, I see some people already doing that here today. Okay? So, just to give you a sense of why we're using Bloomberg, let me log in. In the previous classes, I'd asked the classes about a company to look at, but it's 4:01. People are reporting earnings today. One of the people that are reporting earnings today that's going to be heavily watched, Apple. So if I go to AAPL their ticker symbol, or type in Apple. It'll start filtering out the list of companies. Corp is their debt. Because remember, Bloomberg is a big fixed income data service. So Corp is debt. Equity is analyzing the stock. And then where it says Apple US equity, it means it's trading on a US stock market, as opposed to Apple LN equity would be trading on a London market. So in this case, I'll look at Apple US equity. Now this will give me a real-time quote of Apple, and Apple is up $6 so far today. And I can actually track and look at the shares and see a list of all the shares and lots that have been traded. But we're going to use about 5% of Bloomberg's functionality this semester or less. But here's the key, is that one of the things that's going to be very important to the market is there's a screen on here called earnings estimates. And Bloomberg used to be a data service created in the 80s. It's retained some of its DOS-based legacy. So one of the features of Bloomberg is what's called the short codes. You can type in these short codes to get to a specific screen, or you can click on the screen. One of the short codes we're going to use a lot this semester is called EEO, which stands for Earnings Estimate Overview. So one of the keys is that when Apple releases its press release any minute now, it's going to say what its earnings were and what its sales was for the last quarter. And then the analysts are going to say, how did that track against the earnings estimates? Well, this is a real-time view into those earnings estimates. So right now, when they start their conference call in about an hour, the analysts are looking for this quarter's earnings to be $14.07 a share. And they're looking for their revenue to be $57,476 billion in revenue. So I'm just saying, when you read tomorrow in the Wall Street Journal whether Apple met or missed its earnings estimates, these are them. All right, and so with a data service like Bloomberg, we can get real-time access to the earnings estimates. And by the way these estimates are created is there's a bunch of analysts that are tracking Apple, 44 of them to be exact, that have put in guesses for earnings per share. They then average the 44. That becomes what's called the consensus. So it's the average of the analysts' guesses. And by the way, if I look at the ANR, which is the analyst ratings, I can see here are the analysts. So here's the guy from Cantor Fitzgerald, which has a buy recommendation and that target price on Apple Computer that he updated on January 27th. So one of the things I can do is I can click on this, and this will show me his historical recommendations by day, what his rating has been, what the target price has been, what the closing price has been. Matter of fact, I can also see for this guy from Cantor Fitzgerald is I can see what other stocks he is covering as an analyst, what ratings he has on those stocks, what target price he has on those stocks, and how he has been doing against the benchmark investing in each of those stocks. So that's the point. I can really see not only which analysts are out there, but how good are the analysts at actually predicting what you're doing over time. So again, just some things that you can get out of the database. Another thing you can do is, let's say we wanted to know Apple's beta. You guys had to calculate betas before? Did you? All right, so what I do is I just type in beta, and it pulls all the data. It draws the trend line, and there's Apple's weekly beta for the last 2 years regressed against the S&P 500. If instead of 2 years weekly, I want 2 years daily, I switch to daily, hit enter. It adds all the points, redraws the trend line, slope of the trend line. There's my beta for Apple. So again, if I want to switch to a weekly 5-year view, and there's the weekly 5-year beta for Apple. So again, what makes this data service so powerful and so expensive is that it allows me to use the same things the academics would do using real world data, and it does it for me all in real time. So for example, weighted average cost of capital, WACC. There's the real time estimate for Apple's WACC, because it knows the market value of the equity, it knows the market value of the debt, it knows the weighting, it knows the cost of the debt after tax, it knows the cost of the equity, because it does a CAPM. There's the CAPM. that it's actually using to estimate the cost of equity. If I don't like the risk premium, I could switch the risk premium if I want, and I could recalculate my own CAPM. But again, it's pre-filling it based on today's actual interest rates. So again, just very powerful tools. Matter of fact, the other tool we'll use is RV, stands for relative value. And what that will do is that it will allow me to quickly compare one company against its peers on a series of either predefined templates, or what's even nicer is I can define my own. So for example, here's Apple and its peers, and let's say I wanted to compare ROIC for the latest year, and let's say I wanted to get the WACC for all of Apple's peers, and I select stats and I use a market cap weighted average. There's the industry ROIC, there's the industry WACC for Apple. If I want to know what the average PE is, here is the price to earnings ratio forward 1 year for this industry group of peers. Notice that Apple's trading at 11.39 times forward earnings. The industry average for these tech firms is 12.44. So when we talked about the S&P 500 at 13, the tech sector doesn't appear to be overvalued. It must have been other sectors of the industry that were trading at higher PEs. And by the way, that was a week ago before the market fell 4%. So again, I can get real-time access to this data. You will be using this pretty substantially throughout the semester to do so, and I'll teach you the process to do it. Kind of a little preview of why you're going to be using it. Questions about any of that? All right. A little bit about the format of the semester. So this week, we're going to be talking about what I'll call the fundamentals of value creation. It's really the intro week. So what you need to do this week is, if you don't have the textbook, buy the book, start reading those first 2 chapters, get your Bloomberg account, and start trying to create your own teams. So if you're not in a team, like I said, next week I'll assign you to a team, but it's really your chance to form your own teams before then, next week. No more than 7 people, no less than 5. So 5 to 7 people per team. All right, next week we'll then get into EIC, again talking about the external environment and how we look at that and how it impacts a company's performance over time. That's when the homework will start. So homework 1 will start next week. You'll need to read the valuation book, and stock track trading begins on February 5th. So you'll need to have teams sign up for your stock track account for next Wednesday. The week after that, we'll talk about what's called frameworks for valuation. Homework 2 is part of that. But the idea is we'll talk about the enterprise DCF valuation methodology we're going to use this semester, and the economic profit / economic value added EVA based method we'll use as an alternative. Third, we'll talk about reorganizing the statements the week of February 17th. This is going to be the hardest week of class for many of you, because what we're going to do the week of February 17th is we're going to take GAAP financial statements and we're going to turn them into economic statements and cash flow based statements. And what's ironic is the accountants start with this and create the weird, nothing to do with cash accounting statements, and we have to basically convert them back, okay, to an economic format. If they'd left it in the economic format, life would be so much easier. All right, so that's what we're going to talk to you about doing. This is a specific process developed by the consulting firm McKinsey, and I'm going to teach you their approach for doing this. Okay, so it's really unique to this class. A couple of other classes in this country, they teach this at Wharton, where I went to school, and they teach this at McKinsey, and I used to be part of their analyst training program a number of years ago. So this is what I used to train their analysts on doing as well, is what you're going to be getting in this class. So again, we're going to be going through that process here. It's an extra step that you're not normally taught, but it makes the analysis far easier, and it makes the valuations far more straightforward. So that's a key part of the week, right? So next week is the 24th. We'll then try and analyze these statements that we convert, get used to the format, and we'll practice a couple of conversions. And the reason why that's going to be important is because right after that is your midterm, and it's a 2-day midterm. Day 1 is economic statement conversion day. So literally the first day of the midterm, which is March 3rd, I'm going to give you some accounting statements. You got to convert them to an economic format. There's no surprises as to what's going to be on the midterm. Second day of the midterm is going to be multiple choice and short answer. And it's basically, can you actually understand the data that you've converted and what it tells you? And some of the principles that we're going to be talking about throughout the book. So that's really what the two-part midterm is. And it'll be in class on Monday the 3rd and Wednesday the 5th. So it's like a 2-hour midterm. Next, after the midterm, we'll then get into multiples. So that's the week of the 10th, talking about PE multiples, enterprise value multiples, how they're calculated, what they mean, how we use that in evaluation. You'll then be on spring break. Hopefully you have a nice, happy spring break in a nice, warm place. Come back, and then we'll get into valuation and modeling. Starting the week of March 24th, and for the next 3 weeks, we'll be getting into heavy Excel-based work where you will literally be building an Excel-based valuation model of a company. Last semester, we chose Costco as the common company that we all did. And so I'll pick another company. I don't know who it's going to be yet, but we'll pick one company. We'll all create individually an Excel model valuing Costco. Very detailed enterprise value model. What we'll then do is you'll break that up into 3 homework assignments. You'll turn in a piece of the model along the way to show that you're actually able to catch up. Now, starting the following 3 weeks, after the first 3 weeks of building the model, we then get to April 14th. Those case studies will be 6 classes where we'll literally pick a company a class and we'll do a different company every day in a different industry to apply the model and get different lessons learned about this applies to different companies in different industries under different scenarios. So again, a lot of application work in those next 3 case study classes. Again, you'll be doing homework assignments along the way because I'll then give you out of class assignments where I'll give you industries. You'll have to go get the data, do your own analysis. Along the way, on or about the 31st, I'll give you the industry that we're going to value. You'll pick your group team. And so while we're building the model and practicing the case studies, your team will be doing the same thing with your group project. Okay? So you'll be doing that in parallel to the individual stuff we're doing in class. You'll then, on the week of May 5th, you'll do a 20-minute PowerPoint presentation on your analysis. And May 12th, you'll turn in your paper and your supporting exhibits. Right? And like I said, please turn it in on May 12th. Don't forget to turn it on May 12th. Bad things happen to your grade if you don't forget to turn in assignments. All right, so that's basically the semester. Questions about that? Hopefully pretty straightforward. Yes, sir.
Yeah, you said that the worst group would get a 6 out of 10 on that.
Correct.
Like stock market competition. What is that still the case? Even if that group does a successful job and does
Success means doing better than your peers.
like that?
I'm just telling you. That's why I'm being very candid with people up front because, like I said, this is real world. I'm just saying, you go work for a hedge fund and you make 20%, but if every other hedge fund makes 25, then they just treat you like the scum of the earth. All right? And they don't celebrate the fact that you made 20%. They yell at you because you didn't do as well as the other hedge funds. Welcome to the real world. All right? So again, I'm not going to be as mean because we're not going to fire you, all right? But it will affect your grade. You got to do better than your other teams. Won't kill your grade though. It's only plus or minus 5 points. By the way, the other 5 points is you got to do a write-up of your stock track, and you got to basically write up your trades that you make and why you made the trades. That's the 5 gimme points. That's how you get 6 points. So it's really 1 to 5 for performance, and then 5 points if you write up your rationale. So whatever your rationale is, you just have to write it up. It doesn't have to be a good rationale, but you have to explain, like, why did you buy this stock? So, for example, if you bought McDonald's, you got to have a reason you bought McDonald's, not I like the Big Mac 2 for $1 special or whatever they're offering right now. Like, that should not be the reason that you bought Big Mac stock or McDonald's stock. Yes?
Is the homework an online software, or is it just something that you give us?
No, the homework will vary week by week, but I'll just give you an example. The first homework assignment will be on EIC. So I'll explain the EIC methodology, and then you'll actually have to go get the data to basically prove out the Bloomberg, prove out the data from Bloomberg. So you'll have to go get, for example, I showed you beta. You'll have to go get the beta of a company to talk about the sensitivity of the economy. You'll have to go, in the second screenshot I showed you, is you'll have to go get the industry ROIC and the industry cost of capital to determine whether or not it's a good and attractive industry. You'll have to look at that company's ROIC against the industry ROIC to look at whether or not the company is showing and demonstrating competitive advantage financially. So, so essentially, I'll kind of talk through the process, and then you'll actually have to use the tool to get supporting data. Okay? Because again, as I told my master's class, they're a little bit ahead of you because they started last week, and they have longer classes. Their classes are like 2 hours long, but so it's a faster semester for them. But basically, what I was trying to tell them is, when we look at industry performance, like, it's not, do we think it's a good industry? Like, this isn't some strategy class. This is a finance class. If it's a good industry, you should demonstrate good financial performance. So that's the point. We have to look at observable financial data to determine whether or not something is an attractive industry today. And so that's why we need a tool like this that can quickly get us industry data, that can quickly aggregate that data. Now, we're going to then have to make some qualitative decisions about, is it going to be the same level of attractiveness in 5 years that it is today? But there's also a process that we'll go through to do that. And again, I'll talk you through the process and the other tools to help you do that. But that's why, like I said, it's really a process-driven class, but every week we'll apply the process. Good questions. Other questions? All right, so the other piece of the semester is I will put lecture notes into Canvas in a file, in the file subdirectory called lecture notes. I posted lecture note 1 yesterday, and we'll briefly spend the last 10 or so minutes going through the beginnings of lecture note 1, and we'll finish this on Wednesday. So, the textbook we're going to use this semester is called Valuation, but McKinsey created a second version of this textbook called Value, which is like the Cliff Note version. So what they realized is executives were scared by all the math in the book. So they wrote another version of the book where they took out all the formulas and all the numbers. And that is a book which they call Value. So same principles, they just made it simpler, right? Because again, if you talk to C-level executives, they don't want to see the numbers. They just want to kind of know what it means. So long story short, they're very similar in concept because they're basically summarizing the book that we're in. But I think they do a good job in the other book, at least talking about a couple of the key themes. So I'm going to start with that. So what McKinsey does to summarize the book that we use, which they didn't do in the original book, but basically they say there are 4 major things that drive value for any company. And we need to understand them this semester. These are 4 principles we're going to focus on. They call them the 4 cornerstones of value creation. The first cornerstone of value creation says that value is based on spread. Spread is the difference between the ROIC and the cost of capital. Or in an NPV-based world, IRR greater than cost of capital. So the same thing applies out in the real world. If your internal rate of return is less than your cost of capital, like ROIC less than cost of capital, because IRRs and ROIC is kind of like a one-period proxy for IRR, then basically you don't create any value. The only way you create value is that the ROIC over time is greater than the cost of the money that you're putting to work on a risk basis. So that's one of the key insights we have to have for value creation. And as simple as that sounds, that insight is lost on many companies in the real world. In fact, this is what keeps me employed, right? Because I work with company after company after company who have been growing their revenue, growing their earnings, watching their stock price not do anything, and they wonder why, right? So again, an example of this. I've worked with a company called Royal Caribbean Cruise Lines historically. And again, everything that I'll tell you in this class is publicly available data, right? That you can, if you know where to look, and I'm going to show you where to look, how you can give answers to companies. So, just as a quick example, I'm going to go to Bloomberg, and I'm going to look up Royal Caribbean Cruise Lines, RCL, U.S. equity, and I'm going to go to the financial analysis section of Royal Caribbean, because this is historical financial data, historical income statements, historical balance sheets. What's nice about Bloomberg is I can go to the historical income statement. I can actually click on the revenue. And one of the other nice features of Bloomberg is if I click on the drill down, it'll show me where in the 10K they actually got the data from. That's another nice advantage of the service, is that I know I actually have decent data because they actually foot the data back to where they got the data from. Okay? So, and they're pretty good about putting the data in with any updates. But here's another feature, which is besides getting the 10K income statement and balance sheet and cash flow data, I can actually come over here to custom, and I can actually create my own custom financial statements. So the idea is, software got frozen. Let's try this again. All right, why is, did we lose access to the internet? Is it just me? Because I'm now having the spinning, I can't access the internet button. Anyways, see if it comes back in a second. But here's the story. Under the, yep, I got kicked out of the internet. Try logging back in. All right, well, theoretically, if I'd gone to the FA section of Bloomberg, I would have had my custom financial data, which I could have charted. And I would have shown you that if I charted their revenue between 2007 and 2011, that their revenue went up by $1.4 billion on an annualized basis. So they were getting $1.4 billion revenue 5 years later than they did before. And part of the reason is that Royal Caribbean has been investing in very big ships. As a matter of fact, here is the new ship class that they're building. This is the Oasis of the Seas. They have the Oasis and the Allure of the Seas. These are 5,500 passenger ships. They're huge. To put it into perspective, the original Love Boat was a 500 passenger ship. The new ships are 11 times the size of the original Love Boat. This is a 2,000 passenger Carnival ship sitting next to it. Again, you can see how much bigger the Royal Caribbean ship is. It's like a little toy, the other ship compared to it. Has anybody been on one of their new ships? On a cruise? Yeah.
Went on, I think Majesty of the Sea, was it?
Which
it
is
was
which is
actually a
probably
class.
pretty nice, right?
It was. But we took a class on cruise line industry with Professor Miller, and then
Okay.
we went on the cruise after. But we didn't get to go on one of their bigger.
Yeah, these are basically $1.5 billion floating fortresses. I mean, they're just giant, very expensive ships. So here's the deal. When you look at these ships, and you look at the amount of money, spending well over $1 billion on these ships, they've been spending to grow. And that's the point. They've actually grown. They grew by $1.4 billion in revenue. Their profits actually went up on an after-tax basis. Now, they don't actually pay any taxes because they're not based in the U.S. They base somewhere in the Bahamas, I think, or Bermuda or somewhere. But basically, they put themselves in a non-tax jurisdiction, so they pay no taxes. So their profits went up by about $50 million after tax. All right? So revenue went up by $1.4 billion. Profits went up by $50 million. They've been building these ships. These ships have competitive advantage because they're really nice ships, and people love them. And one of the reasons they love them, and it's a subtle but important difference, but every one of these is a balcony cabin. Every one of these is a little hole in the side of the ship. So one of their competitive advantages is everybody gets a balcony. All right, and that's very important to getting higher rates and all, more revenue. But here's the thing. They put $4.5 billion of invested capital in that 5-year period, new borrowed money to buy these ships, into the business over 5 years. So what the investors said is, you spent $4.5 billion of borrowed money to generate $50 million of profits. What's that return on investment, approximately? It's about 1%. So incrementally, you got about a 1% rate of return on the investment. And you know what? I didn't think that was worth it. So their share price went from about 42 to 25. So it wasn't that they were growing, and it wasn't that they're not building these beautiful ships that the customers absolutely love. But the problem is they spent so much to do it that the investors said, you know what? It's not worth the risk for all the money that you spent, even with the growth, because you're just not getting the returns. And that was the timing question at the time of 2011 about what is going to happen in the future. And again, they had a different point of view than Carnival, because Carnival's like, it's really the difference between Airbus and Boeing, where Boeing is betting on the 787s and Airbus is betting on the big A380s. Everybody been on one of those? These are the 600 passenger planes, the A380, 680 passengers, some of them will hold. 787 is about 300 people. What's the difference between Boeing and Airbus? Everybody know in terms of strategy with these two planes? Boeing is betting on fuel efficiency. Composite planes, composite materials, smaller planes, less risk. Cost a little bit less than the Airbus planes. So you can only stick 300 people in them. But they're more fuel efficient and they're easier to turn around. The big Airbus, which is the almost 700 passenger planes, basically they're big behemoths. You can stick a lot of people on them, but they're not as fuel efficient and they're giant planes. There's only a few airports they can actually land on because these things are so big. But that's the point. It's Royal Caribbean is almost looking at the same way. Royal Caribbean is like Airbus. They're building the giant ships. Carnival's building the smaller ships. What would be an advantage to building smaller ships? What happens if there's a recession?
That's people riding the ship.
And then you got to fill the ship, right?
Right.
So what happens?
Fill the small ship.
It's easier to fill the smaller ships. So if you think about it in a risk-based strategy, they both have different views of risk. So Carnival's like, I'll take more smaller ships, and Royal Caribbean is like, I'll have fewer bigger ships. All right? Now the bigger ships are gaudier and they're nicer, and like they are literally floating Four Seasons. Carnival's like, you know, nobody spends any time in the room. You're drunk anyways. So Carnival's like the party boat, and they're the smaller party boats. But that's the idea. Carnival saying, you know, we forego some of the revenue from having the nicer ships, and everybody have a balcony that they're probably not going to be at during this shipping cruise anyways. And the idea is we don't take the risk in an uncertain economic environment, where Royal Caribbean was more willing to take the risk. Different strategy. Unfortunately for Royal Caribbean, they took this risk in a global recession. So how it plays out really depends on what happens in the next couple of years. So if in the next couple of years the economy really stays strong and people go back to cruising and they're able to get great average price per cabin day, then Royal Caribbean would have been a great time to buy them in 2011. But that was the point. It really depended on your view of the future at that point in time. And over the historical 5 years, investors were very worried about whether that future would be materialized. So that's what we have to start to understand. What is the spread, right? And what is that spread likely to be over time? Because that's going to determine your value. And what questions do we have to assess to figure out the spread? All right, we got to do the math, but we also have to understand the assumptions behind the math. Real quickly, I'll run through a couple of other points. The internet is unreliable right now. Second point, you don't create value through financial reengineering. So the idea is, there's a concept known as enterprise value, which is the total cash available to the debt equity holders and taxpayers. As you shift the amount of debt and equity, it doesn't change the enterprise value of the firm. So the amount of total cash the company makes running its business doesn't change as you change how much debt and equity you have in the firm. This is Modigliani Miller, and it kind of plays out in the real world. So the idea is that financial reengineering doesn't change enterprise value. It changes the claims on the enterprise value. Now, what I call that is financial redistribution. There is value to fight for some of the cash at the expense of the debt holder or the government if I'm a shareholder. But it doesn't mean that there's more cash to pay out. So what we're going to focus on this semester is enterprise value. Not how do we distribute the cash most efficiently, but how do we know how much cash is available and what will influence how much total cash, total enterprise value is available to be paid out over time. Third principle, a company's value is based on expectations. Company's worth the sum of its future cash flows. The challenge is, what are those cash flows in the future? We have to guess. So the value of a company is actually based on the guesses of the cash flows. Here's the conundrum. Let's say I'm able to guess today what Royal Caribbean's cash flows are with pretty good certainty for the next 10 years. Fast forward 10 years. What's going to be true in 10 years? Is the value of Royal Caribbean the previous 10 years? It's actually the next 10 years. So that's the point. The value of the firm is always future-based. It's never historical. So basically what it means is that I'm always basing the firm based on guesses. So I need to know what those guesses are. That's, again, one of the reasons why we're going to be using Bloomberg a lot, because Bloomberg gives us access to the guesses of the institutions, something that the average investor never sees. And the institutions control, the top institutions, between 70 and 90% of most big companies. So they are the price setters for these companies. And we have to understand how those estimates are set and what those estimates are, and more importantly, when they change, because that's going to determine the values of the companies that we're analyzing. Fourth, the long-term value of the company will be based on competitive advantage. Over time, companies earn average rates of return. So what I really have to think about as an investor is, can a company earn an above average return? If so, for how long? So what it will depend upon is two things. One, how good is the industry? And two, how good is the company? Now here's what becomes a subtle but important difference. I can have a great industry and a mediocre company, and that will likely outperform a bad industry and a well-run company. Because even if I'm great at running my business, if the business is bad, I can't make money. Where if I'm in such a good industry, any idiot can make money because the industry is just so profitable right now. So in a way, we have to think about that when we think about selection of companies and the values of companies over time. As a matter of fact, one of the most famous investors in the world today is a gentleman by the name of Warren Buffett. Those have been the two rules that have served him well over the long run. Find good industries, find the best run companies in the industries. And when he invests in companies, he's looking at a 30-year time horizon, not an 18-month time horizon. Because Berkshire Hathaway is at its heart an insurance company. So when Warren Buffett left business school at Columbia, he took over Berkshire Hathaway as general manager of a textile company, and he realized textiles were a dying business. So he basically sold out the textile business and reinvested the proceeds buying insurance companies. And one of his first was Geico. And he now owns 100% of Geico. You see their Blizzard ads all the time. So he buys insurance companies. And so the whole idea of an insurance company is all about long-term investments, because there's two ways you make money in insurance. One is through underwriting, but two, it's through investment income, because you want to invest the premiums before they're paid out and get as much return as you can over time. And the insight that Warren Buffett had 30 years ago is that all the insurers were hiring top academics to come in and create diversified portfolios, and they were all earning similar rates of return. So he basically said, if I do what everybody else does, I'm going to earn what everybody else does. The only way I don't earn what everybody else does, if I do it differently, pick individual stocks. He believes the market isn't as efficient as the academics believe, and that he can pick individual stocks better than the average investor. And specifically, applying his two rules, he thinks he will outperform the market. Find the good industries. Have a point of view about what industries are going to do well. Then bet on the best run companies in those good industries, and those are the investments that have served him well over time. Give me one of his most recent investments. Anybody know who Berkshire Hathaway has been buying recently? He bought Coke back in the 90s. So he's had Coca-Cola for a long time. Yeah. He bought Burlington Northern Railroad a couple years ago. Why did he buy Burlington Northern? How boring can you get? The railroad industry. It's been around for 150 years. Yet he actually thinks for the next 30 years, railroads are a great growth business. Why? What's so great about railroads? Well, one, trade. There's a lot of global trade. We've got to move a lot of goods around, particularly in the U.S., from Asia to the ports, and then it's got to go from the ports and the docks inland. Well, from the ports and the docks, it's going to go inland one of two ways: by train, by truck. So here's what Warren Buffett's insight has been. $100 or more oil prices. Energy prices are high. and will remain high in the future. Despite the fracking boom in the U.S., energy prices remain high going forward, right? Because there's so much global demand now for energy as all the other countries industrialize outside the U.S. So here's the point. At high energy prices, rail has a huge competitive advantage to ship goods versus trucks. So that's his point, is that people are going to want to ship via rail because it's so much cheaper to go rail versus truck. As a matter of fact, what's happening in that industry is they're actually putting the trucks at the dock onto the rail cars, and they're shipping them via rail to the near the end point, and then they're driving the trucks to the final destination. Yeah.
Did he buy into Exxon then?
Recently, he also bought into Exxon because he also believes in high energy prices and diversification, because you go to clean energy, Exxon's in clean energy. You stay with oil, Exxon's in oil. Great high price business. Okay? Second, find the best run railroad, Burlington Northern. Find the best run oil company in the world today, Exxon. It's really easy to be Warren Buffett, right? By the way, I'll give you one last investment that I mentioned in the other class. He also bought into a company called Heinz. Who is Heinz? Ketchup. You know, I was in Pattaya, Thailand 3 months ago. And you know what? They have Heinz ketchup in every table. Doesn't matter where you go in the world today, you're going to find Heinz ketchup. Why is Heinz ketchup, in Warren Buffett's mind, a great opportunity for the next 30 years? Because that's his time horizon. He's looking at a 30-year investment. Yeah.
I know all these countries are kind of industrializing and becoming more westernized, I feel, so fast food is probably going to grow.
Well, it's not just fast food. It's just as people are getting wealthier in these other economies besides the U.S., the macroeconomic data says that the wealthier a country is, the more protein makes up people's diet. Well, how does that translate to ketchup? Yeah, protein is more meat, more chicken in your diet. And so basically owning the slaughterhouses, the cattle houses, is an ugly business. He doesn't want to be in that business. But owning the ketchup that goes on the beef, well, that's tied to the growth in the beef. So that's the point. He looks at condiments as a protein play without having to own the slaughterhouses themselves. And that's the point. He's betting on the long-term growth of protein. He's betting on the long-term growth of condiments that will be spurred by protein. And then he bet on the best-known brand in the world for condiments with the best-run company. And he bought into Heinz. That's what he does. He doesn't go in and say, I know how to run your business any better than you do. He wants the people that know how to run their business well, that are actually just not perceived to have the right value by the market. Because he thinks the market had it wrong with rail. He thinks the market had it wrong with Exxon. He thinks the market had it wrong with Heinz. He has a strong point of view of those trends. He thinks he's going to be right. He's got a pretty good track record. Now, he's not always right. Here's the last quote I'll give you. 1997, my first adjunct position, I happened to be at Atlanta, and I got asked to teach it at Emory, which is the Goizueta School of Business, because Roberto Goizueta made a killing as the Coke CEO. And Emory had a giant endowment, even though they were a small school, because they got a big grant of Coke stock like 100 years ago, and they kept it. And it became worth more than $1 billion. So the school had this giant endowment because it was all Coke stock. As a matter of fact, the faculty was arguing about should they diversify, because literally their entire endowment was Coke stock. And they're like, should we get out of Coke? Because if Coke takes a hit, what are we going to do? But because Berkshire Hathaway had a big investment in Coke, Warren Buffett used to go to Atlanta a lot. And he used to stop by Emory and talk to the students. Matter of fact, at Emory University, he actually had one of his most famous quotes. And this was in the 90s. But his quote was, what's the fastest way to make $1 million in the airline industry? Yeah.
Didn't say like invest like $1 billion.
Invest $1 billion. And he joked because he said, in paraphrasing, I went against my rules. Because he invested in US Air. And he thought US Air was a really well-run airline at the time, and he thought they were undervalued. And he said, you know what? I think they will outperform everybody else, even though the airlines at the time were a terrible industry. And he lost his shirt. And he admitted, he said, look, I made a mistake. I thought that a well-run company, even in a bad industry, could do well, but it kind of proved me right, that I should have remembered that if it's a horrible industry, no matter how good you are, you're selling a commodity where everybody matches prices, there was overcapacity, there was no discipline for pricing, and the end result was he lost a lot of money in the industry. So that's the point. He's followed those two rules generally well. It's made him money over time. As you think about your stock track simulations, I would say, can you apply those rules to the companies that you're investing in over time, and can you translate that into a better grade? As we think about EIC and we think about the values of companies, can we understand how the future of the company looks? Because eventually we've got to predict cash flows, and this will give us some inference into the cash flows that we predict. Those are the 4 principles that we're going to focus on this semester. Yeah.
Well, wouldn't we be using different principles than him because his principle are more long-term based, but we only have like a couple months?
Great point. Now, there's another principle, though, on the McKinsey list, though, that you do care about. So, yes, he's looking at a long-term time horizon. So what you're going to learn how to do, so it's a great point, subtle point. What does bullet point number 3 say on the slide?
A public company's performance is driven by change in expectations rather than just essential.
So in a 3-month period of time, what matters most is expectations. So what you really need to start to understand is what companies have expectations that can change, and can you profit on the changes in the expectations? That is really what's going to be more important in the short run, right? Now, it doesn't hurt to have a long-term point of view on what is going to be a successful company, but ultimately, that's why I said it doesn't hurt to pay attention to the news, because if I looked at, hey, market PE is 16, average PE is 13 on the S&P 500, we're seeing tapering of interest rates, we're seeing companies miss cash flows. I'm just telling you, it should be like a big flashing sign that says, hey, I might want to consider shorting some stocks, or I might want to put some cash in the sidelines, hold it in cash versus owning stock for a couple weeks until this sorts itself out. So that's what I said. We got to start thinking about those, because again, in any market, you should be able to find a way to make money. All right, we'll pick up from here on Wednesday.
How did most people do on their group project last semester?
Oh, very well. I think the average grade was like an 18.5 out of 20.
But I mean, if you have like bad economic times though, or like not as precise growth that was happening last semester, then how does that translate into?
Well, it's all relative. So a couple semesters ago, the winning team actually, I had 24 teams across 4 sections. Only 2 teams had positive returns. 22 or 24 teams lost money. So 2 winning teams just lost the least. It's relative performance.
So we're competing across all the sections, not
No,
just our
just your
class?
section.
Okay.
Yeah, so it's you against the other, most likely 5 other teams. So it's how you do relative to them. So it's not whether you make or lose money, it's how is your relative performance against theirs. That's what matters. Yes?
I have a question. I'm already using StockTrack for another one of my classes.
You'll still have to sign up it again,
another one?
because this one's tied to A, this class, and B, the timing is everybody starts with $1 million on that day.
Okay.
So you'll still need one for this group for this class.
Okay, all right, thank you. And do you have any recommendations? This class is my first time using Bloomberg or really anything like that. Do you have any recommendations on something I could use to kind of get more acquainted with it, or should I just go on Bloomberg?
Acquainted in what way?
I'm just familiar with like the features and how to look things up. Like I really have no idea.
Well, I actually have a little worksheet that they gave me, like a little how to get started guide that I'll be handing out on Wednesday.
Oh, okay, perfect.
So that'll help too.
Okay, thank you very much.
Yep. Yes.
Yeah, I'm on the waiting list, number 4.
Okay.
So, do you think